Hi guys, welcome back. This is a summary of episode 5 of the ICT Mentorship 2022. Please refer to ICT original content. This is just a refresh that as a fellow student of yours I'm presenting here for you, and you can use it as a reminder of all the things from episode 5 before switching to episode 6. So let's get started. In this episode, we're going to be talking about index futures and specifically about the E-mini. We're going to look at how to set our daily range and at intraday layouts. But keep in mind that if you're interested in trading the Asian range, for example, this episode and the things that we're going to go through in this episode are not really applicable. Index futures are actually contracts, specifically a type of derivative contracts that are done between a buyer and a seller that agree to pay a specific price for a specific index at a specific time. Throughout the year, as you can see just right above me, there are 4 delivery months, which are March, June, September, and December. Index futures as contracts expire, and they actually expire the 3rd Friday of that specific month. So remember, do not trade them after expiration date. When should we trade which contract? Well, to answer to that question, we can go on barchart.com and select in the top menu the index future that we are interested in. We have a list that appears with different contracts that are about that specific index, and we should be ignoring cash because of course it is not what we are looking at. Guys, we are interested in trading the contracts with the higher or highest liquidity, which also means that in those months in which the contracts are expiring, which are March, June, September and December, we should always go on bar chart and check the open interest of the contract that we are trading are high or higher than those of the following months. Let's go through the example that Michael is giving us in episode 5. Let's assume that we are trading the E-mini S&P 500 futures and we are bullish here. We are expecting the price to rise. What to do first? Well, we have to start by setting our chart at New York local time and setting it at the 15 minutes time frame. After that, we are gonna be framing our trading sessions, which go from 8:30 to 12 and then from 1 until 4:30 in the afternoon. This is gonna be our trading window. Now that we have our trading window, we are ready to start. So what should we be looking for next? The next step is to look, for example, in the morning at the most significant swing highs and swing lows and to sign those points with an horizontal line. Above and below those lines, we're gonna find liquidity. Now that we have our buy side liquidity and our sell side liquidity, we are ready to switch time frames and from the 15 minutes time frame go to a lower time frame such as a 5 minutes time frame. Here on the 5 minutes, we're gonna be searching for obvious displacement. And what is even a displacement in price? Well, ICT gives us a comparison and tells us, think about a swimming pool. And now imagine a huge elephant jumping in that swimming pool. How is the water gonna react? It's gonna jump all out, it's gonna be everywhere, it's gonna make a big splash, right? This is what we are looking for in the graph, in the price behavior. After the price goes above or touches an old high or an old low, for example, what we want to see is obvious displacement. We want to see the price moving forcefully away from it. Quickly. It has to be like really a sudden move. So let's go back to our chart. Here, zoomed in, you can see an obvious displacement. The price has touched upon an old high and right away it has moved forcefully away from it. It has displaced, remember the water and the elephant? That's exactly what we can see here. And now we should look closer and see, do we also have a fair value gap? And the answer is yes, we have a fair value gap here. So we're going to be waiting for the price to tap back into the fair value gap, if it does. And at that point, we're going to want to short. How should we be trading? We should enter the trade for a short when the price taps back into the fair value gap. And we know that already. But where should we actually put our take profit for that short? We should go back and look at the previous low, see if there are previous fair value gaps that the price could be attracted to, and place our take profit there. Michael stresses quite a few times the importance of avoiding to trade during New York local time at like lunch, so from 12 until 1. And I just want to show you here, put it in red in your graphs, and remember, no trading during lunchtime. So lunchtime has passed, we had our break, and we're ready to go back to trade. How should we take advantage of the afternoon? Well, first and foremost, we should wait at around 1:30 in the afternoon, because that's the time in which we expect to start seeing the price forming swing highs and swing lows. So let's go back to the graph and let's see what happens around 1:30. Indeed, exactly at that time, we see one being formed. After that, what happens? The swing low that got just formed gets violated. And that's the moment that actually really starts the run. With the violation of that swing low, the algorithm starts a buy program. That buy program is labeled by Michael ICT as spooling, which means that the algorithm will just buy more and more. It's gonna be a very quick and violent move. Guys, many days are designed as such, in which we have a morning move, a lunchtime break during which we don't want to be trading, and then an afternoon move. Michael invites us to be backtesting and to really keep track of what was the morning move and what was the afternoon move. If in the morning, for example, we were bullish, what happened in the afternoon? If we have, for example, a consolidation in the morning, what was the move of the previous day or the previous 2 days? How are they related together? Take notes in your journal and try to understand and really spot the connections. On a normal day, Michael tells us that index futures are cleaner, more predictable compared to Forex, that sometimes can be a little bit ruthless. Michael gives us a very good and interesting note for the afternoon session. The afternoon has some mechanisms built in that help the price accelerate towards the end of the day, so towards the closure. You should be backtesting and checking what the price is doing around 3:40, 4 in the afternoon, of course, New York local time. Michael tells us that the afternoon session can absolutely be traded if we know our daily bias and we know our expected range expansion for that day. And of course, for this reason, we got a homework assignment also in this episode. Whatever index future you decide to be trading, take your time, go back at least 2 months and take it day by day on a 15 minutes time frame and really follow the steps described in this episode. Set the range, analyze the price movements, tell yourself the story of the price in chronological order. Record your findings, journal them. After you do that day by day and you have recorded and written down your findings, analyze the price movements per week. And so, keeping your daily, look at the weekly and ask yourself, how did the price behave? The 3 days prior, it had that crazy good move on which you could have profited so much. How was the price behaving before? If necessary, feel also free to consider the previous week. Guys, keep doing the work. Don't give up. It's not supposed to be easy. It's supposed to be worth it. This is the way.